What are dividends? How are they received? At what time periods can you expect to receive a dividend? And how does it affect investors? Hi, I'm your host, Kevin McGrath, and this is Financial Media. So what really are dividends? Dividends are a way in which a company's overall profits attained during an earning cycle can either be 1, reinvested back into their company, or 2, distributed to shares of their own common stock. Usually a business that declares a dividend tends to be more on the profitable side. This means that there's higher cash flow within the business. That being said, there are 2 ways in which you can receive dividends. The first way is that you can receive dividends through cash dividends. Cash dividends are where in which a company overall dividends are deposited directly into your portfolio. Imagine, say you own a company such as Coke. Say you own 200 shares of that company, and the overall dividend for that quarter is 0.46 cents. You will obtain approximately $92 for that amount of shares you owned. The second way in which you can receive dividends is through DRIP. DRIP is a dividend reinvestment plan. This allows for your overall money to be received and then redistributed back into the original company you own. Let's take Coke for example again. This means that for the amount of $92 that you earned from dividends would be reinvested back into Coke, allowing you to purchase additional 1.53 shares. Now, how often do companies pay out dividends? This all depends. Either it could be a quarterly basis or a monthly basis. A dividend overall received in your portfolio is not guaranteed. A company can choose either to not do it on a certain date, or it could also be that they don't want to declare the dividend anymore. It never is guaranteed. Note that as an investor, it is also important that you must own the company between its certain record date, or your overall amount of dividends won't be received during that monthly, quarterly dividend. So what do dividends bring to investors? Well, dividends allow for your overall allocation to increase within the company or for you to earn easy passive income. With this, it also is careful to bear in mind that a dividend can also be risky. As an individual, you should always focus solely on a company's performance year over year rather than just on its overall dividend yield. So what is dividend yield? Dividend yield is a way in which investors can calculate their overall dividend return or annual income paid over the course of that year. So how do you calculate the dividend yield? Well, to calculate the dividend yield, you would take the total amount of the last quarterly or monthly dividends within the year and divide it by the current stock price and multiply that total to 100. Let's say, for example, that you have Coke, and it's at 0.46 cents for its dividend rate. 4 quarters total will equal $1.84. You take the overall 1.84 and divide it by the share price of the stock, which is 59.84, just to say. Then you multiply that total by 100 and you get a value of 3.07%. This is your dividend yield. The dividend yield constantly changes over time. Overall, dividends can increase the stock appreciation of an individual investor's assets over time. However, this is not financial advice, so you always have to apply your research when investing to any stocks or assets in general. Make sure to like, comment, and subscribe below.